The trillions in stimulus that have been issued since the great financial crisis and accelerated last year in response to COVID have resulted in a weakening US dollar and fast rising inflation. And the Federal Reserve and the current administration claim they're committed to pumping out further trillions for as long as it takes. All this intervention is massively deforming, distorting, and disrupting the road ahead for today's investors, most of whom are totally unaware of how the rules are changing and totally unprepared for what's coming next.
And so we've been spoiled by this idea that there's a formula with which to make money easily and restfully. The things that used to be risk-free in the traditional portfolio have become highly risky. And people don't get that yet. And a lot of financial planners don't get that.
Hello, and welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another week of making sense of money and these markets. And we're very fortunate to be joined today by a great mind and an even greater friend. I'm welcoming John Rubino, who is the proprietor of dollarcollapse.com and the co-author of the book, The Money Bubble. John, thanks so much for joining us today.
Hey, Adam, good to talk to you again. And congratulations on Wealthion. I predict a bright future for you guys.
That's very kind. Well, we're off to a great start if we're getting notable minds like you on the program, John. All right, so let's just dive right into this. John, you and I talk pretty regularly, I'd say almost weekly, which is a huge benefit for me. And I'd love to give our listeners a little bit of a fly in the wall experience to those kind of conversations. So to kick things off, if I can just ask you the same question I ask all of our guests at the beginning, just because I don't want to introduce any bias one way or the other. What is your current assessment of today's economy and financial markets?
Well, I think as we have been for the past 20 years, we're screwing up on an absolutely biblical scale, and we're going to pay a huge price for it in the future. You know, when that happens exactly is hard to say, but something very serious is coming because of the mistakes that we've made in the past and that we continue to make.
All right, and so I guess that's a great jumping off point here. So you started your website, which is called Dollar Collapse, because you concluded long ago that our debt-based fiat monetary system would ultimately end in a currency crisis, hence dollar collapse. Can you explain, some of the specific reasons why you came to this conclusion?
Yeah, well, the basic story begins in 1971 when we broke the last remaining link between the world's big currencies and gold. Prior to that, gold existed at the basis of the global monetary system, and it limited how much new currency governments could create. Take that away, and it handed everybody basically an unlimited credit card. And human nature being what it is, we've been abusing the ability to create money out of thin air ever since. With all the consequences that you would expect. We're now a debt-ridden society, or every major society at every level is debt-ridden. And we've got these ever bigger booms and busts. The amplitude of the cycle keeps getting bigger and bigger, so that each bust requires an even bigger bailout on the part of the world's governments. We have to create more debt, we have to create more currency and dump it into the banking system. And there was always, this endpoint out there where a bust would be so big that it would force the world's governments to bail out basically everybody in sight, and that would shift the pressure over to the currencies. In other words, we'd have to create such a huge oversupply of dollars and euros and yen and pound sterling that the value of those currencies would just fall off the table one day. In other words, inflation would start to really rage. We'd have a hyperinflation, which would cause either absolute chaos or, at a minimum, some kind of big monetary reset. And that we're playing out according to that script. Each crisis is bigger than the last one, and the pandemic lockdown turned out to be that might be the one that does it, because that has required such an immense amount of money from the world's governments. The U.S. is going to run a government budget of about $6 trillion this year, 3 trillion of which is going to be borrowed. Those numbers are just absolutely insane. So it could be that we're at the point where the current crisis is requiring bailouts that are so immense that we can't go on much longer this way. But who knows, but anyhow, the story remains basically according to script. Each crisis is bigger and the bailout has to be bigger. And the amount of debt that we carry forward is much, much bigger. And eventually that blows up the system. So I don't know where we are on the process time-wise, but we are certainly closer than we were 2 years ago.
Okay, so many questions coming out of that, including one I was just about to ask. Maybe you don't want to answer it, but I was going to ask you, since you're saying that, hey, who knows? Maybe the policy response to the pandemic might actually be the thing that really tips us over. If you had to guess, what inning would you say we're in here?
Well, it feels like we're in the later innings of the game and possibly the ninth inning, but I have no credibility when it comes to calling the timing of things like this, because I thought the housing bubble bursting would have been the end of the game. And I didn't think we could get beyond 2008, 2009 without some kind of a really serious monetary crisis / reset. But we managed to do it. We borrowed tens of trillions of new dollars and just ran the printing presses nonstop and bought ourselves another decade of what looks like normality to the average person, but is actually, complete insanity under the surface if you look at the numbers. So since we did that once, who knows if we can do it again? It's possible, but the numbers that would be required for something like that are just so unearthly that it's hard to put another 10 years like the last 10 years in the category of probable. I suppose it's physically possible, but it seems highly unlikely to me. I think that we're getting closer and closer to the end of the game. So seventh inning, eighth inning, probably, ninth inning, possibly.
Okay, and you've been tracking this for a long time. I think I started reading your site, John, I want to say in 2008, if not sooner. And you wrote your book, The Money Bubble, back when? When was that published?
Well, let's just say I had black hair when I started telling this story. So yeah, The Money Bubble was 2014, co-written with Gold Money's James Turk. And that was our attempt to explain what has now become the everything bubble. In other words, previous bubbles were basically sector specific. You had gold and silver in the 1970s and junk bonds in the 1980s and tech stocks in the 1990s and housing in the 2000s. Those were bubbles that expanded within their sector, caused a lot of crazy things to happen, then burst and threatened but did not take down the global financial system. The current bubble is in a lot of different places at the same time: government bonds and housing in the US right now, and tech stocks, and it just goes on and on. Cryptos, very possibly. So this is such a broad-based bubble that you have to really trace it back to the currency and say that the actual current or the actual bubble is in fiat currencies and the government bonds that are based on them. So when this bubble bursts, it won't just be some, Amazon went down by 95%, kind of thing. It'll be everything in your portfolio is thrown into chaos. Your bond funds are tanking. The cash in your bank account is getting less valuable. Your tech stocks are tanking. Your real estate is doing things that you never thought it would do. So this is a different animal. And that's what we were trying to get at with the money bubble. And, so far it's turned out to be true. The everything bubble is just expanding and expanding and expanding with no real end in sight. Although, you have to recall from history that when there's no end in sight, that's usually when the end is right there. If you can't imagine something stopping, then it's ready to stop.
Yeah, when the end is not in sight, it means it's imminent. Well, I mean, what concerns me is that you are a smart guy who's been tracking this for a long time. You have written about the likely trajectory that the process is going to take, and it has been basically progressing according to script. And you think we are in the later stages of this, right? So I think your perspective is probably better than most in terms of where we are. So that is quite worrisome. So let's actually talk about kind of the end here, or what the ending looks and feels like. So, really there's sort of, when you get to a place where false prosperity has been built upon an unsustainable system, where I think we can make lots of arguments that describes where we are today. You really only have two options at the end of the day. You either have to let all of the malinvestment clear, right, which is very deflationary. That's where bad debts get defaulted upon, companies, stocks that are any asset that's been bid up to speculative heights, crashes back to a more fundamentally based valuation. So that's very deflationary. The other option is just to inflate you inflate the value of the currency away, where you meet all your obligations nominally, but you've just destroyed the real purchasing power of the currency. And so I guess open question to you, John, is where, how do you think this is likely to unfold? I assume in the long arc, it's a currency crisis where these fiat currencies either become worthless or worth little enough that they want to shift to a different currency regime. Is it just a straight path to that, or is there a risk of, some big market correction on the way here?
Yes, there is a risk like that. To add historical perspective to this, you could say that our choices are another Great Depression or another Weimar Germany hyperinflation. So we're looking at those two scenarios without a realistic middle way that gets us painlessly to some kind of sustainable financial system. So, how it progresses from here is a very interesting and tricky question, because if it was just the amount of debt that we've taken on and the amount of bad debt that's now bubbling up, another Great Depression would be kind of obvious, right? Because all of this debt is just going to blow up on us at some point, and people are going to go bankrupt by the millions, which will wipe out the debt, but it will also wipe out their creditors, and so on until everybody's broke, or everybody but a handful of people are broke. That looks very logical based on the amount of debt we've taken on. But for the first time in history, every country in the world is armed with an unlimited printing press. So they can basically create if the debt bubble is huge but finite, the amount of currency that can theoretically be created to prop up that debt bubble is infinite. So you've got a gigantic number on one side and a potentially infinite number on the other side that will probably come to pass. Governments aren't going to let us descend into a 1930s style deflationary depression, because they become the Herbert Hoovers of our generation then. They're the guys who presided over and screwed up the best economy in the world. They don't want that to happen. And their only option is to combat the inevitable deflation that comes from having too much debt with newly created currency. So they're just going to, they're going to do what they're doing now, right? They're going to run the printing presses until they get some kind of growth out of the system. And for how that's going to look, you can basically look at what we're doing right now. We're creating amounts of new currency that would have been absolutely inconceivable to economists of 15 years ago. And we've got interest rates at negative levels around the world now, and zero in a lot of other places. So we're already doing things that kind of fit the bill for creating infinite amounts of currency to combat another Great Depression. So we're kind of living in that endgame scenario right now. And the question is, are they going to create more? And what happens if we push interest rates down into, say, negative territory in the US and increase the money supply growth from the current 30, 40, 50%, depending on the measure that you choose, to 100%? What happens then? Common sense says you get a hyperinflation, but we've got all this debt out there that is just unprecedentedly immense and going to be really hard to combat. So we can't say for sure that the inflationary path is the one we take out of this, but you can say that the governments are going to try for that. That's going to be government policy to inflate our way out of this mess. And we're just going to find out if it's physically possible. And nobody's ever tried this before on this scale globally. So we don't know for a fact that any one thing is possible, but that's what they're going to try for. So over the next few years, or maybe over the next few months, who knows how this goes time-wise, we'll see absolutely crazy amounts of currency be created and dumped into the banking system. And we'll see what it does. There are a few things that are almost certain to flow from this, but a lot of other things that are very uncertain because there's no historical precedent for them. So, volatility and uncertainty are really the only two things you can say that are guarantees going forward. And then possibly gold and silver. Beyond that, I don't know what I would say is highly likely even in the near future.
All right, well, that's actually a great transition because I want to now get into the more tactical parts of things, but I do want to sort of reword what you just said because it sounds great, which is I think the only thing we can be certain of, you're saying, is uncertainty, that there will be more uncertainty going forward, more volatility, et cetera. And that's sort of where I was going right before we get into potential specific solutions to look at. My observation from interviewing many great experts like you over the past bunch of months is almost to a person, they feel like we are in one of, if not the most treacherous times in living memory for investors because of that uncertainty. You can feel like, okay, I know where this is going to end, right? It's going to end with more currency printing. It's going to end with a more devalued dollar. That's going to have an inflationary impact on prices in the long run. But there's so much debt out there. There are so many unknown weak points in the system, and Archegos is just sort of one small example of that, right? People that are using excessive leverage and everything is trading right now at huge levels of speculation. So you could have a domino effect where certain overextended players fail and that ripples through the economy. So where I'm going with this is, even though the ending, we might feel we have a relatively high degree of probability in predicting, the path there is unpredictable. And I think the authorities have told us, the Fed's been straight up, hey, we're going to try to maintain a certain amount of inflation and try to keep everything within that nice band. But what might end up happening is them having to ping pong between more easing, more tightening, more easing, more tightening as inflationary pressures really begin to bite into society the way that they were doing back in the 70s. And why I'm kind of hammering this point home is it makes it really hard for the investor because you can't really, there are a few sort of set it and forget it investments you can make out there, I believe. Because if we have this volatility, if we have this sort of whipsaw trajectory, you might position yourself for the right ending, but you might get killed way before you get there because the trend goes in a different direction for a period of time. Do you see a similar risk?
Oh, I see myriad risks out there. Yeah, but yes, even by doing the right thing for the long term, you can lose a ton of money in the short term when every market freaks out simultaneously, which is what we tend to get when, for instance, stocks tank. They tend to pull everything else down with them, including precious metals. So, you could say that historically, and this is absolutely true, two things about gold and silver. Historically, they have held their value through pretty much anything that humanity and nature has been able to throw at them. So for 3,000 to 5,000 years, they've been valuable no matter what we're doing. And so it's highly likely that they will hold their value going forward. So over 5 to 10 years, your purchasing power will be protected if you have a lot of it in precious metals. However, a stock market flash crash or more than a flash crash, a very serious bear market would take gold and silver down with them. So you could lose 30 to 50% of your money in precious metals in the short run while you're still doing the right thing long term. And that's the kind of thing that we're looking at. And basically the same thing is true of any asset class you want to look at right now. That they might do well in the long run, with the exception of government bonds. Forget about government bonds. They will not do well in the long run, but they might do well in the short run. Anything you buy now carries kind of a chaos risk element to it. In other words, things could just get so crazy that even this thing you chose that is really the right thing long term could lose you a lot of money. And there's this, there's no solution to that because it applies to everything. It applies to the bank, the money in your bank account. It applies to your house. It applies to the gold and silver that you have stored in a safe place, to your tech stocks, everything. So one way you counter that is with diversification. Spread your wealth around a little bit instead of concentrating it in one sector, because any one sector is vulnerable. And the other is try to skew your finances in the direction of real things, because they at least have long-term utility. Even if their price fluctuates along with the rest of the, the financial asset world, farmland can still feed you and feed your neighbors and produce something you can sell, no matter what the dollar is doing. Gold and silver over long periods of time have held their value really well, as I said. That's money. That's money that you can spend if you need to. If your bank account is unavailable for whatever reason, or the dollar has its own flash crash and all of a sudden your cash is worth less, gold and silver will still hold their value, more than likely. So if you skew your finances towards real assets where there isn't a counterparty risk, et cetera, there's utility, you'll tend to do better in times of chaos, just because you own something that can actually be used for something else. They can actually bring you a benefit in real time, in real terms. So financially, that's the best advice I can offer, even though it's possible that the things you buy might fluctuate in value along the way. It's completely possible that if we have a deflation that comes before the inflation, in other words, if the bond market blows up before the Fed can try to inflate away the dollar, it's possible that that even things like well-chosen rental houses and farmland and gold and silver will go down for a while, but not for very long, because the government will respond to any kind of a deflationary event out there with an unlimited printing press, pointed straight at whatever happens to be going down at the moment. And so you'll make your money back, whatever short-term losses you have in real assets, and then some, and then some, and then some, for as long as the crisis lasts. So, I wish I could say buy this and it will go up from now to infinity. But that's not possible now. All that's possible is that you diversify into the sectors that will probably hold their value better than other sectors going forward.
Very, very well said, John. And it's very corroborative. We have the Wealthion online conference this weekend. And folks, if you're watching this before Saturday, June 5th, you still have a chance to register for that. Just go to wealthion.com/conference. But John, I would say most of the speakers at the conference similarly say that nobody's got an exact crystal ball, but a lot of them think probability-wise, we are likely to see some sort of deflationary crunch in the not too distant future. Some are predicting months, some are predicting, next couple of years. And then they all expect, as you said, just, unbelievably massive central planner stimulus response to that, making like even what we've seen in the past year look like child's play. So, where I'm going with this is, and you did a great job of really, I think, explaining and articulating this, is you can't be lazy here. And I don't mean to make that sound pejorative, but in past eras, there were places that you could park for safety. It's a lot harder to do that now, right? You park yourself in cash, which is a very real position to be in if you're concerned about deflation, but it's getting eroded, while you're waiting, if inflation continues to rise the way that it's doing right now. Obviously, if you get out of cash and go up the risk curve, you then become at much greater risk of a big market correction. And some very notable people are predicting quite a large market correction. I mean, you've got really venerated guys like Grantham who are predicting a 50% market correction like this summer. You got guys like Dave Hunter, who's talking at our conference, who's predicting more like an 80% market correction. And so the reality, the thing I'm trying to drive home here for people is, we've really enjoyed a decade, really kind of multiple decades of easy driving for passive investment. You could buy an index, set it, forget it, and it would pretty much make money dependably for you year after year. We're now entering an era where active management is going to become a lot more important, where you need to be looking at the markets and being nimble, reacting to what the reality on the ground is. For a lot of people, they don't have the time, bandwidth, or experience to do that themselves. There's the people that we tell, hey, go work with a professional financial advisor. I'm going to bring on the guys from New Harbor relatively soon. That's why I have them on this program, so they can hear from one. You don't have to work with New Harbor, but you should work with somebody like them, given the era that we're entering into. All right, so enough of that. But real quick, I'll give the torch back to you here, John. But you did what I was hoping for, which is you said, okay, look, I think a good category of investments for what's coming are hard assets. You mentioned a few, farmland, et cetera. I know you're real excited about gold, silver. Feel free to make any commentary based on what I just said, but I want to now kind of transition into, what do you think are some of the best ways to invest in gold and silver for capital preservation, purchasing power protection, but also I believe, I don't want to put words in your mouth, I think you believe that it's actually going to be a good place potentially for wealth growth going forward, given the higher inflation coming.
Yeah, Adam, you made three really important points there that I want to touch on. The first is that it's been easy for us as investors, basically for a lifetime. And the reason for that is because we have been in a credit super cycle since World War II, where more and more currency and more debt have been created year after year after year, which really smooths things out because it makes stocks go up and bonds in general become more and more valuable over time. So the average investor could be in, 50% stocks, 30 or 40% bonds.
Could have been in anything practically.
Cash. Yeah, and basically that's all you had to do in 1949. And you would have made money on balance every decade going forward. You would have done great. And so we've been spoiled by this idea that there's a formula with which to make money easily and restfully. Now, what was the second point? There was another point. Yeah. Suddenly, the things that used to be risk-free in the traditional portfolio have become highly risky. And people don't get that yet. And a lot of financial planners don't get that. The idea that cash and bonds have any risk associated with them is not mainstream understanding yet. But the fact is, because we're screwing up the currencies, the financial assets that depend on the value of our currencies are at extreme risk right now. In other words, they're not risk-free anymore. So if the dollar tanks, in other words, a bond which pays you dollars year after year goes down in value as well. Same thing with the bank, the money in your bank account, it goes down in value too. So the hideouts of traditional investing are no longer a safe place to be anymore. So, if you have a financial planner put you in stocks, bonds, and cash, it's possible all three of those things go down at the same time. A lot of retirees couldn't handle something like that. That would destroy their plans and send them back to work if something like that happens. So that's what you got to worry about now. And because of that, you need expert advice that is not mainstream. You can't trust a traditional financial planner who's using, this cookbook formula to allocate your money to safely do that anymore. So you need somebody who's going to, do what I said. Look at the hard asset side of the spectrum and skew in that direction. And that's something that the average stockbroker or financial planner would say is kind of alien and excessively dangerous because it's not well understood. But you kind of have to take that the conceptual leap right now in that direction. And because most people don't know how to do that, it's helpful to have pros that do know how to do that walk you through it.
All right. Well, you're setting the New Harbor guys up just beautifully. So they're going to send you a really nice fruit basket after this video. We hope you've been enjoying this conversation with monetary analyst John Rubino. The interview continues over in part 2, where John explains the role that hard assets can play in protecting the purchasing power of your portfolio, as well as sharing some specific sectors and companies that he views favorably right now. To watch part 2, just click on the link provided in the description of this video below, or go to youtube.com/Wealthion. But before you do, please don't forget to click the subscribe button below if you haven't already. Oh, and if you'd appreciate a free, no strings attached portfolio review by a financial advisor who takes into consideration the macro risks and market opportunities that John mentions in this video, just go to wealthion.com and we'll set one up for you. Okay, I'll see you over in part 2 of our interview with John Rubino.